Thank you. So I'm welcoming you to this evening class, and we are going to look at some topics that financial management entails. Some topics that financial management entail, and we say that financial management has 14 topics. It has 14 topics, and one of the topic I'm going to dictate. One of the topic is overview of financial management. Overview of financial management. Generally, this entails the highlights or what financial management involved. What financial management involved. By that I mean, from the word itself, financial management. Financial management. So when I say financial, that deal with the finances. To deal with the finances. Then the next word is the management. So we are trying to manage what? Finances. We are trying to manage finances because we know that we are dealing with the scarce resources. Therefore, these resources need to be bought using the finance or the money, and therefore you need to know if you are dealing with a company. If you are a company manager, you need to know how you can utilize the income, how you can utilize the money that you have to make sure that your cash flow balances very well. Your cash flow has no problem. Your cash flow has no problem. That is the inflow and the outflow. The inflow and the outflow. So inflow should always be higher. Inflow should always be higher. So next topic is the financing decision. That is topic number 2. Financing decision. Financing decision. Financing decision is our topic number 2. Our topic number 2. Financing decision. So under this topic, you are going to learn how the company or how the structure of the organization is made. You need equity to run that business. You also need debt to run that business. There is nowhere you'll find that a company is being operated, or the operation of the company is being carried out without debt. If someone tells you that I run a company and we don't borrow, that company existing in the next, maybe let's say 10 years, existing maybe in the next 10 years, its existence is not certain. Its existence is not certain. So the company, for the company to succeed, they must combine debt and equity. Debt and equity. So we shall see how that is carried out. Then we have topic number 3. Financial institutions and markets. Financial institutions and market. Financial institutions and markets, where we can borrow some fund, where we can borrow some fund, where we can borrow some fund, where we can borrow some funds. And also under the topic we shall see the regulatory authority. The regulatory authority. The regulatory authority. Then topic number 4, I think this is where now you started. Time value of money. Time value of money. Time value of money is our topic number 4. Time value of money is our topic number 4. So small highlight under that is that a sharing today, the value of the sharing today will not be the same in the 10 years time. The value of a sharing today will not be the same in the 10 years time. For instance, if we can look back some 40 years back, one sharing had a lot of value. One sharing had a lot of value. You could use it to buy several things and get change. You could use it to buy several things and get change. What about nowadays? Does one sharing has value? Nowadays, does one sharing has value in our country? Does it has value? Just compare the scenario. One sharing. Currently, even if you give your child 1 shilling, she or he is going to throw it away, kwa sababu unajua sasa unanipatia hii nini, itanunua nini? 1 shilling has no value. So that means the value of money changes with time. The value of money changes with time. The value of money changes with time. That is topic number 4. Topic number 5. Topic number 5 is a business stroke financial asset decision model. Business stroke financial asset decision model. Business number 5 is a business stroke financial asset decision model. Decision model. And then we have topic number 6. Topic number 6, introduction to capital structure decision. Introduction to capital structure decision. By the way, the general rule for a student who is studying this or who is learning these subjects is that you should put yourself in the shoes of a financial manager. In the shoes of a financial manager. Even when you'll be answering that paper, you will be the manager. Now, all of us are financial managers. All of us are financial manager from now henceforth. Or financial analyst. Because by the end of the subject, you'll be able to analyze some projects to know whether they are viable or not. To analyze some projects to know whether they are viable or not. Therefore, put that shoe of a financial manager. Topic number 7. It is introduction to capital. No, that is 6. Topic number 7 is introduction to capital budgeting decision. Yes, introduction to capital budgeting decision. Introduction to capital budgeting decision. Introduction to capital budgeting decision. This is whereby we shall see how the investors make their decision before they invest in a certain project. We shall see. It's a very, very interesting topic. Topic number 8, financial statement analysis and forecasting. Financial statement analysis and forecasting. Financial statement analysis and forecasting. Let's pause a bit and get a signal whether we are together. At that topic number 8. Topic number 8. So under that topic number 8, you'll be able to analyze the financial statement. The financial statement that you are going to analyze under that topic is the income statement and the balance sheet. Income statement and the balance sheet. You're going to identify, you're going to know whether the company in the next maybe 2 or 3 years will be making profit, or how was the performance of the company in the last 3 years? How was the performance of a certain company, maybe Safaricom Limited, in the last 3 years? So the analyzing of a financial statement will really help you to gain that knowledge. Then number 9, topic number 9, we have working capital management. Some of the element of the working capital, is like inventory, receivable, and so on. Inventory, receivable, etc. So you're going to know or to understand how you can manage your receivable, how you can manage your payables, how you can manage your inventory so that you're able to run your business efficiently and effectively, making the right profits. Topic number 10, dividend decision. Dividend decision is our topic number 10. Dividend decision is our topic number 10. And this topic, you'll be able to understand that we usually, the company or any industry or any organization pay dividend from retained earnings. Pay dividend from retained earnings. Then we have topic number 11, introduction to portfolio analysis. Introduction to portfolio analysis. A very interesting topic, interesting topic whereby you'll be able to learn about risk and return. Risk and return in a certain investment. Risk and return in a certain investment. You'll be able to differentiate or to understand if you have two investment project, and you want to know which investment project is the best, or which investment project will give you higher return. When we say investment project is the best, it's giving you higher returns. It's giving you higher returns, and you also be able to identify whether the project has high risk, whether the project has high risk. But in finance, we do say that the higher the risk, the higher the return. The higher the risk, the higher the return. But it depends with the type of the investment. It depends with the type of the investment. That is topic number 11. Topic number 11. Let's go to topic number 12. That is Islamic finance. Islamic finance. Islamic finance. You're going to learn some of the terms under Islamic finance, some of the good terms that they are used under Islamic finance. You're also going to learn about how they do invest. They do invest. In fact, Islams, they don't believe on interest that is attached on the principal. They don't believe on that. If you go to borrow in the Islamic bank, they give you the money without attaching any interest. But you're going to learn how they do operate and how maybe they gain. How they gain. Sometimes they can tell you the project that you are going to undertake using that money, a certain portion you can share to them, but they don't want to relate any interest to the money that they lend to you. They lend to you. Then we have personal finance management. Personal finance management is our 13th topic. Personal finance management is our 13th topic. Now, when we talk about personal finance, we are talking of your money. We are talking of your money. How do you manage what you earn? How do you manage what you earn? For instance, if I give you a scenario here, say, for example, you are earning a net salary of 50,000, and you are living in Nairobi. So how can you manage that cash to make sure that it sustain you throughout the month before the next pay? How can you manage that cash to make sure that it is sustaining you throughout the month before the next pay? That is what you're going to learn under that topic. Then the last but not the least topic is contemporary issues and emerging trends. Contemporary issues and emerging trend. Contemporary issues and emerging trend. That will be your topic number 14, which will be the last topic for the semester. But it does not matter the order that Mwalimu will opt to use. the important thing is to have the concept. The important thing is to have the concept. So I hope that okay. The last topic, Sauda wants me to repeat the last topic. The last topic we have said that it is contemporary issue. Contemporary issue. Contemporary issues and emerging trends. Emerging trends. With that class, I think I've highlighted all the topics that we are expected to cover throughout the semester. So class, you're going to allow me I can touch something small under time value of money. And touch something small. And then I'm going to introduce you topic number 7. Which name are we given topic number 7? So I want to test you, those who are there last week. I don't know whether you went ahead doing something. Yeah, introduction to capital budgeting is topic number 7. I'm going to introduce to you. But that is after we are through with something small and the topic that you covered. Something small under the topic that you covered. What was your last point? Under that topic? In fact, I will not dwell much on this. This just highlight kidogo because of those who are not there. And this is the backbone. So the concept that I'm going to share with you, please note it very well. Time value of money. As we have said that a shilling today is different, or the value of a shilling today will be different from the value of a shilling in the next 10 years. In the next 10 years, it's not a wonder you find that now in Kenya shilling, 10 shillings will now be like 1 shilling. 10 shilling will now be like 1 shilling. That means whatever that 1 shilling is or was buying, then 1 shilling will not buy. But now 10 shilling will buy the same item. 10 shilling will buy the same item. If a sweet costed us 1 shilling some 10 years back, 10 years ahead, 10 shilling will buy that 1 sweet. 10 shilling will buy that 1 sweet. That is the effect of time. The time period on the value of the currency. By the way, emerging issues, we shall look at things like Bitcoin. Bitcoin. I know you have heard of Bitcoin. Bitcoin. Good. So, under time value of money, we are able to compute the present value of cash flows. We are also able to compute the future value of cash flow. We have 2 types of cash flow. Who can give us the 2 types? Or who can mention for us the 1 type of cash flow? We have 2 types of cash flow. who can mention for us one type? One type. Let me see those who are in class. I just want to introduce this all to just give a clear highlight to make sure that all of us are at par. Let's see those who are there. Ama hamkufika hapo. Ama hamkufika hapo. Regular and irregular. Thank you very much. Thank you very much. We have regular cash flow. It's regular or uniform, so that you're able to remember cash flow. And then we have the irregular or non-uniform cash flow. So I want us to discuss something. Thank you so much. This is who? Edward and Celestine. So if I have regular cash flow, if I have regular cash flow and I want to get the present value, which formula do I use? Which formula do I use? Or which discounting factor? Which discounting factor do I use? I have regular cash flows and I want to get the present value. Which discounting factor do I use? For the regular cash flow, we use CIFA. Thank you. Thank you very much. CIFA. And for the irregular, we use PVIF. Sasa niwapeleke pole pole. So PVIF stands for present value interest factor of annuity. Present value interest factor of annuity. The formula for PVIF, is, the formula for PVIF is 1 minus 1 plus R raised to power n, in fact negative n, divided by R, where R, what is R? What is our R? What is our R here? Our R is the rate of return or cost of capital. Cost of capital. N is number of years. N is number of years. N is number of years. Then PVIF, on the other hand, PVIF is the present value interest factor. Its formula is the smaller of these. Its formula is the smaller of these. Who can give me the formula for PVIF? The formula for PVIF? The formula for PVIF? Someone to give me the formula for PVIF. PVIF. The smaller. Wacha tuone. The formula for PVIF, it is 1 plus R formula. 1 plus R raised to power negative n. Never forget this. Ukisahau hizi inakuwa hatari zaidi. This is very important. Very important. As far as financial management is concerned, even in the advanced level, you are going to use these formulas. These formulas are very, very important. I usually say that this is the backbone. Is backbone. Backbone. So, assume a minute. So, assume that we have this exercise. And say exercise. Sasa hapa, remember, I usually test speed of the student. Speed is also examinable. Speed. So we have an exercise here, and I have here 0, 1, 2, 3. Alafu tuko na cash flow. Cash flows. Cash flow tunaweza sema hapa tuko na 10,000 or 100,000. Let's go with 10,000. Then 6,000. 6,000. 7,000. 8,000. Good. Can someone tell me which type of cash flow is this? 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 Irregular cash flow. Therefore, to discount, we shall use that formula. But there's something that we have not included. Assume that our cost of capital is 12%. Cost of capital is 12%. Compute compute the present value. And net present value. Net present value. Assume you get such a question. Where do you start? Where do you start? The first thing is to get the discounting factor. Discounting factor. Are we going to get the discounting factor for year 1? That year 0? Year 0? In fact, it is always 1, because this is initial outlay. It is always 1. It is always 1. Initial outlay. So hiyo haina shida. What is the discounting factor for year 1? Discounting factor, give me that value very fast. Give me that value very fast. Discounting factor for year 1. Nipatiwe hiyo value so that we proceed. Kindly remember now, speed is examinable. Speed is very crucial. So let's see who will be the first to give us the discount. Do you know how to? You can use this or use the table. Can use this or use the table. Use this or use the table. Weka hii 1 plus, what is our R? 0.12 raised to power -1. We are dealing with the year 1. So Yvonne is giving us 0.8920. You have to round off, okay, 0.8929. Thank you very much. 0.8929. Give me the second one. Give me the second one for year 2. Do the same. Can use the table or use the calculator. For the calculator, you just take 1.12 raised to power -2. But 0.79, 7972 from Yvonne. Someone else to confirm that. Someone else confirm that? Then we proceed. Then we proceed. Kuna mwenye na confirm hiyo. Kuna mwenye na confirm. 79. You're just feeding the figures. Just feeding the figures. Just feeding the figure. And for the irregular cash flow, this figure usually reduce. So we expect also the discounting factor for year 3 to be below this. You see? So when you see unapata vitu mingi mingi, unajua you are not on the right path. So what about for year 3? What about for year 3? Thank you, Edwin, for that confirmation. Thank you, Edwin, for that confirmation. Let's go for year 3. Let's compute that of year 3. Wacha to compute hiyo ya mwaka ya 3. 0.7118. 0.7118. Thank you and thank you very much. Thank you and thank you very much. So this is the present value or the discounted value. Discounted value. Remember, this is our initial outlay. So initial outlay yetu tunaiwekaga in a negative form. Ili tukumbuke hiyo ni initial outlay. Hata hapa tukiweka in negative haina shida. Now give me the present value for year 1. Present value for year 1. Just say you multiply. You just multiply. You just multiply. You just multiply the cash flow with the discounting factor. The cash flow with the discounting factor. Tunapata nini? Tunapata nini? Tunapata nini? Nitawapea pia swali yenu, alafu niwapatie like 5 minutes, and then we see who will be the first one. So I want us to practice together. So this is 535. No, 53, 57.4. 0.4 or 0.8 now. Now let's look at our decimal point. Sasa hapa namna gani sasa? Edwin anapatia 0.4. In fact, na Yvonne anapatia 0.8. Na ya Yvonne ni 56. Na ya Edwin ni 57. Now, I'm going with 53, 57.4. Yvonne, check. Maybe you are rounding off. This is 50. 53, 57. 57.4. One decimal place is okay. 53, 57.16. Sauda. Okay, your decimal point, ndio tu inaleta shida. Always round off to 1 decimal place. Always round off to 1 decimal place. Let's go to the next one. The next one for year 2. Just pick 7,000 times 0.7972. Napata 5580.4. Edwin anapatia hiyo. Someone else to 5580.4. That is the result. 80.4. Let's move to the next one. Thank you so much for that confirmation. Let's move to the next one. Even Edward, Yvonne, and Celestine go the same. Go the same. 5694.4. 5694.4. I hope that is the correct figure. 5694.4. 5694.4. Who is confirming? Thank you very much. Thank you very much. Can you give me the total? Can you give me the total present value? Total present value, you add this. Total present value. The first thing they want us to get the present value. Total present value, you use these figures. Total present value, nipatieni total present value ni ngapi? Ongeza hizi zote, hizi tatu zote. Hiyo ndio inapatia total present value. After this, I'm giving you an exercise here to attempt. To attempt. Ni ngapi? Ni ngapi total? People are engaging their calculators. No. Hiyo nitakuonyesha. First of all, get this. For the 3. Is it really visible? The 3? Yeah, for the 3, to get the present value, total present value, you add the 3. People are getting 16,632.2. 16,632.2. Thank you and thank you very much. That is the present value. That is the present value. Now, to get the net present value, you take the present value minus initial outlay. The present value minus initial outlay, which is equivalent to 16,632.2 minus 10,000. Minus 10,000. I think this one will give me, it will give me what? 6632.2. 6632.2. If this is a project that you are trying to, thank you very much, to analyze, how would you advise the person maybe willing to invest in this, or who wants to invest in this project? Assume this is a project without this type of cash flow. How would you advise this person? How would you advise the person? Yes, the project is viable. Thank you very much, Edwin. The project is viable. Therefore, the organization should undertake the project or accept the project. Thank you, and thank you very much. Thank you, and thank you very much. Undertake the project. If we got a negative result, that means that project is not viable. That project is not viable. If we got a negative result, that means the project is not viable. Your exercise that you take 5 minutes. Exercise 2. Really visible? Yes, it's visible. 1, 2, 3, 4. Okay. And then you're told that the cost of capital, use 10% as the cost of capital. To determine, use 10% as the cost of capital to determine the total present value and the net present value. Aye. Assume you are given 4 marks. Who could get the 4 marks? Who could get the 4 marks? Tani. This is 2 to determine. Hapa to determine. Use 10% as the cost of capital to determine the total present value and the net. So for this, first of all, we can determine the discounting factor. Discounting factor hii ni moja. Hiyo ni moja, haina maneno. Hiyo haina maneno. Give me discounting factor for 1. It will be the same. Ama, oh, no, we have a different rate. Will the year? Sauda is asking ya 0. Wakati mwingine hata hutapewa hii ya 0 utapewa in words. Wakati mwingine utaambiwa the initial outlay is 60,000. The initial outlay is 60,000. Yvonne anapatia 1991. Next one very fast, very fast. Next one ingapi? Year 2, 8264. Year 3 is 7513, very fast. Year 4, the last one. Year 4, the last one. The last one ingapi? So that we look at our present value hapa. Ina remain kuwa 60 negative. Year 4 nimepewa 6830. Ukifika hapa hii kitu umemaliza. Give me this one for year 1. The present value for year 1. Present value itakuwa ngapi? Very fast, finish up. Itakuwa ngapi? Nataka mwenye hakuwa ameiona vizuri. 63637. 63637. Thank you. Next one 24792. 24792. That one ingapi? Tuiseme tu 15026. 15026. Then the last one ingapi? 3415. Thank you. So total present value hapa 1 ni total present value haya ni ngapi hiyo? Hizi zote naongeza hizi zote except 60, 106870. 106870. And then the initial outlay we have, so 106870. Then we have to raise to get our net present value is equal to 106870 minus 60,000. And people are giving us 68. People are giving us what? What's the difference hapa? Ukitoa hii kwa ngapi? 46,870. 46,870. Okay, the last one now for you. The last one now for you. That one, 2 minutes. 2 minutes to complete that. 2 minutes to complete that. In the Kambiri. Determine the present value using the 14% as the cost of capital. 2 minutes. 2 minutes. You malize na Kambiri. I want to introduce the difference. Good. I want to show you the easiest. I don't know whether these will work. So the formula, which type of cash flow are these? Which type of cash flows are these? Which type of cash flow are these? Regular or irregular? Regular or irregular? Regular cash flow. Therefore, we first of all have to, you can go through the long method, or you just find your PV farm. 1 minus 1.14 raised power negative 4. Then this one, whatever that you get, this one, you divide by 0.14. Tulipata nini? Tulipata nini hapo? Nipe tu hii. Hii imetosha. Hii imetosha. Ulipata nini hapa? It should be a whole number point. It should be whole number point something. 2.91 to 4 decimal places, 9137. 2.9137. Now, because all this cash flow, year 1, year 2, year 3, year 4, ni similar. Unachukua moja, una multiply na your PVFA. So it will be 50,000 times 2.9137. Niambie tunapata nini? Niambie tunapata nini? Niambie tunapata nini? Niambie tunapata nini to 1 decimal place? To 1 decimal place. To 1 decimal place. Unachukua moja. 50,000 multiply by half. Unapata nini? Pata nini? Ah, umepata? Nani wamepata 0 something? 145, 685. 145, 685. That is the magic for this. For the regular cash flow, that is the magic. You just have to get the PVFA. You get the PVFA. Yes. 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 Thank you very much for noting that. Yeah, thank you very much for noting that. That you just use, we have 4 years. Yes. You just raise that to power -4. If you have 10 years, you do the same. So you save much time. You can as well do this way, but that one will take much of your time. Much of your time getting the discounting factors for each, and then it's all the same. It's all the same. It will help you to arrive to the same answer. It will help you to arrive to the same answer. I hope that is clear. I hope that is clear. And because I've seen that that one can give you challenge, do this within 2 minutes. Within 2 minutes now, because you know how you are expected to do it. Sasa ukishajua hizo, hapa sasa hakuna maneno. Hapo hakuna maneno sasa. And then if we get time, we shall do another one which has ranges. So we have here. Then we have cash flow. This is the last one. Then I introduce to you something new. Determine the NPV using 10% as the cost of capital. 10% as the cost of capital. Your examiner and twist to your mind. Determine the net present value, NPV, using the 10% as the cost of capital. That question can earn you 5 marks. How many minutes do we do that with? 5 minutes. 5 minutes. We go to the next day. So I know that to get the PVFA is 1 plus or 1 minus 1 plus R raised to -n divided by R. So to get this is 1 minus 1.1 raised to -7 divided by my R is 10, 0.1. How much are we getting hapa? How much are we getting? Hii ndio tunahitaji kwanza. How much? Tunapata ngapi? It should be a whole number points. whole number point. When you are looking at PV4, ni whole number. Get whole number. Hata ukitumia table 4.8684. 4.8684. Alafu nachukua moja hapa 20,000 to get the present value first. 20,000 times 4.8684. Unapata ngapi present value? Ngapi? Ichukua 20. Moja tu, moja imenitosha. Moja imenitosha. I save my time for another 97,368. 97,368. And then the examiner wanted net present value. So to get net present value is equal to this present value 97,368 minus 50,000. Minus 50,000, which are actually giving me 47,368. 368. Thank you very much. That project is viable. Also, this one is viable. Also, this project is viable because we have a positive NPV, a positive NPV class. I think up to that point, you have an idea of discounting these cash flow. You have an idea of discounting cash flow. If we get another time, we shall look at discounting cash flow with ledges. Discounting cash flow with ledges. Maybe you're given 1 to 5 year, you're given cash flow yake. 6 to 10 year, you are given cash flow yake. We shall see how do we discount that. But for now, allow me to introduce topic number 7. Topic number 7. Topic number 7. Topic number 7. Is that okay? 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 Ama niwaonyeshe hiyo complex. Okay. We introduce topic number 7. We introduce topic number 7. That is introduction to capital budgeting decision. Introduction to capital budgeting decision. Hiyo complex nitawaonyesha baadaye. Ama nani walikuwa wanasema tufanye hiyo? All right. Majority has it that we introduce topic. Okay, you can have the heading. Introduction to capital budgeting decision. Introduction to capital budgeting decision. Introduction to capital budgeting decision. As we said earlier, that this topic will help us or will equip us with the knowledge of knowing which is the best project, to invest in. And the best project, we mean that the project is able to give us higher returns. The project is able to give us higher return. Is it a short-term project? Is it a long-term project? Which project will be the best for us to invest in? Which project will be the best for us to invest in? At that point, we shall be putting the shoe over an investor. We shall be putting the shoe of an investor. Yes, I have project B and project C. Project B and project C. Which appraising or appraisal technique do I use to determine whether to invest in project C and not project B? That is the concept. That is the concept. In fact, you shall see that the concept of NPV is also under this topic. The concept of NPV is also under this topic. Very, very interesting topic. I hope that all of us will enjoy. I hope that all of us will enjoy. Are we together? Are we together? Are we together? Kwa pamoja. So class, let's introduce this topic. We say that investors, just start and say that investors have a variety of investments. Investors have a variety of investment. Therefore, we need to do an informed decision. We need to do an informed decision. We need to do an informed decision to analyze. We need to do an informed decision to analyze which investments give higher return. Gives higher return. Which investment give higher return? Which investment give higher return? We have long-term project. Long-term project. It's a type of investment. Long-term project. Is investment, or it's a type of investment whereby we expect the type of investment where we expect to receive where investors expect to receive future benefits. Where the investors expect to receive future benefits. Investor. Yes, Yvonne. Yes. Thank you very much. I don't know whether, Yvonne, you are doing a repeat of the paper. Oh, no. Probably, Yvonne, you have done this in college. Probably you have done this in college. If you did finance. So, a long-term project, the type of investment where investors expect to receive a future benefit. In fact, ni kama tu wewe. You cannot do a business. For more than 2 years without getting a return, without getting benefit from that business. In fact, you close the business and do something else. Close the business and do something else that is more important than that business that is not giving you something. The business that is not giving you something. Therefore, we have some characteristic of a long-term. Just write please. Characteristic of a long-term project. Characteristics of a long-term project. What are some of the characteristics of a long-term project, by the way? What are some of the characteristics of a long-term project? We can have one. I don't know whether visible. Yes, one, that is visible. One, initial investment is high. Initial investment is high. Initial investment is high. Initial investment is high. Number two, characteristic number two, it will require a significant timeline. It will require a significant time lag. This means between significant time lag between capital commitment and receipt of benefits. Can you add for me? Number three. Ah, good. Edward anatuambia capital intensive. Ndio hii. Long term project sio mchezo. Number three, we can say that long term project require commitment. Or if not commitment, once you invest, they are irreversible. Long-term projects are irreversible. And that's why you're being advised to first of all make an informed decision. Before you undertake or before you emerge to any investment. You have to make an informed decision. Because you find that there are people that venture into investment, maybe due to peer pressure, you see. Yeah, mwenzangu invest hapa, hata mimi nita invest, you see. Such decision is not an informed one. The decision should be solid. And it should come from within you. Because you are investing millions of money. When we say it's capital intensive, we are talking about millions of money. You invest millions of money in a certain project that you're not sure of. You're not certain. Therefore, you need to be very keen. Overall risk is they affect overall risk of the firm. That is Yvonne telling us. They affect overall risk of the firm. They affect, yes. You find that some firms do some investment. For example, let's take a department like NSSF. NSSF has a lot of money. For Kenyans. A lot of money. The pension. So they cannot keep that money in their accounts until you retire and go and pick your money. What they do, they invest that money. You can see the risk they are taking. Si pesa yao, ni pesa ya mwananchi ama employees. But they invest that money with that expectation of getting a return. Assume ile project wame invest in IBAX 5 ama zote zikunywe maji. Nasema kukunywa maji. What do you think will happen? And then maybe hiyo mwaka zimekunywa maji, ndio maybe 200 employees wanna retire. What do you think will happen? That is what Yvonne is telling us. They affect the overall risk of the firm. Yes. Yes. They affect the overall risk of the firm. So another characteristics is that uncertainties in cash flow. There are some uncertainties in cash flow. There are some uncertainties in cash flow. You are not sure. You are not sure of what may happen. Future benefits are received. Future benefits are received. Yeah, that's very true. In a series of years. Zima ugoje. For it to mature, you have to wait. For it to mature, you have to wait, by the way. You have to wait. It's a long term. More than 1 year. It should mature in a period of more than 1 year. In a period of more than 1 year. So those are some of the characteristics. We have some classification of investment projects. Classification of investment projects. Investment projects are classified into 5 categories. Investment projects are classified into 5 categories. One of the category is mutually exclusive. Mutually exclusive projects. Mutually exclusive project. This is a project that cannot be undertaken together with another. It's a project that cannot be undertaken together with another project. That is category number 1. Category number 2 is independent projects. Independent projects. The independent project can be undertaken alone. Or we've said that the mutually exclusive project cannot be undertaken with or along another project. Now, for the independent project, this project can be undertaken alone. Then we have dependent projects. We have dependent projects. So this project is depending on the other. This project is depending on the other. This project is depending on the other. So it cannot be undertaken alone. It cannot be undertaken alone. That is the dependent project category. Then we have number 4. Category number 4, we have divisible projects. Divisible projects. These are projects that can be undertaken partially. They can be undertaken partially. Whereby, when you say partially, this project you can earn income before its completion. You can earn income from that project before its completion. What are some of the examples of divisible projects? Divisible projects, example moja. You can earn income from that project before its completion. Ni kama nini? Tuone watu wenye wana deal na projects. Let's see those people who deal with that. A school. Thank you very much. Yes. In fact, That is a good example. Another example is a building, a story building, rentals. Yeah. Thank you, Manasseh. Thank you very much. Yes, rentals. You find that mtu ameanza ghorofa kubwa, amejenga skeleton. But sasa kwa sababu ya pesa amemaliza first floor na second floor na ground floor pia, na watu wameanza kukaa na wengine wameanza kufanyia mabiashara pale. Pata pesa, anaendeleza hadi mwisho. So that is an example of a divisible project. You can benefit from it before its completion. Then we have indivisible. You cannot divide. Indivisible projects. Mtu atupatie mfano wa hii. A project that cannot be divided, cannot be undertaken partially. Na useme at you can benefit na haujamaliza. An example of such project ni gani? An example of such project ni gani? Niwapatie moja. Construction of roads. Wakati msituni hakuna njia kwa msitu. Ati waanze kidogo, waweke rami kidogo. Sasa hiyo njia inaenda wapi sasa? You see, they have to complete. Hiyo barabara lazima itokelezee the other side. Construction of bridge. Naona kuna bridge. Sasa ati mconstruct nusu, and then hiyo nusu ingine mtaconstruct baadaye. Is it really possible? Is it possible? Na construct nusu and then hiyo ingine ni baadaye. Is it making sense? It's not. So those are some of the examples of a indivisible project. The project that cannot be divided. You cannot benefit from them. Cannot benefit from them before its completion. Good. So our next thing, we shall look at the investment appraisal technique. Investment appraisal technique. Investment appraisal techniques. So this refers to ways that we use to identify the best projects. Of course, don't ever forget that when we talk of the best project, we are talking of the project question. Manasseh ako na swali. Manasseh, I'm responding to you, saying when we talk of the best project, we are referring to a project that will give us more return. We are referring to a project that will give us more return or higher return compared. In fact, you need to compare with another one. So we have several projects. Okay. There's a question by Manasseh hapo. Anauliza tofauti ya the main difference between mutually exclusive and independent project. Remember what I've told you, that for the mutually exclusive, it cannot be undertaken together. together. That is mutually exclusive. What about independent project? Independent can be undertaken together. Independent can be undertaken together. I'll give you assignment. Go and look at, for example, examples that fall under this. Examples that fall under mutually exclusive project. These projects cannot be undertaken together. The example of independent project, and then example of dependent. So go and look up for the examples. I hope, Manasseh, you are better off. Better off. So we move to the next item here. Manasseh, tuko pamoja. No, Manasseh ametoka meeting. One can be undertaken together and the other one cannot be undertaken together. So that's the major difference. That is the major difference. So let's see ways that we can use to identify the best projects. Ways that we can use to identify the best projects. We have some appraisal techniques, the NPV, IRR, as Yvonne was mentioning. We have payback period. Let's first of all see the characteristic of a good investment project. Characteristic of a good investment characteristic of a good investment appraisal. What do you think could be the general characteristics of a good investment appraisal? Good investment appraisal, or a good method to help us determine or identify the best project. What do you think would be the best good characteristics of a good investment appraisal? Wacha tupate moja kutoka kwenu. Kutoka kwenu. One. Thank you, Yvonne. Yvonne, you have a point. They use cash flow profit and not the accounting profit. Thank you very much. Yes, there's a difference between accounting profit and the cash flow profit. There's a difference between accounting profit and they should consider time value of money. So that you're able to, if it is a future value, you are able to bring it to present. If it is present value, you are able to take it to the future. So one, they use cash for profit and not accounting profits. Use cash for profit and not accounting profit. That is one of the characteristics. Number two, they consider time value of money. Hii ni muhimu sana, Time value of money. They consider time value of money. Another one can say It should recognize all the cash flow. It should recognize all the cash flow. It should recognize all the cash flows. It should recognize all the cash flows under consideration. Under consideration. Under consideration. It should recognize ranking. Yeah. Okay. Let me check my camera. My camera here. A minute, I check my battery. So, sorry for that. Sorry for that. So I think let's complete this. You say number 4. Number 4 can say that it should be consistent. It should be consistent with the shareholders main objectives. Main objective. Specific investment appraisal technique. The last one, the last thing that we are doing today, we shall proceed from there. We shall proceed from here. Specific investment appraisal technique. Appraisal technique. We have one, category 1, traditional technique. Traditional technique or non-discounted. So under non-discounted, we have 1, payback period, and 2, we have accounting rate of return. Accounting rate. Today these accounting rate of return. Can you finish that? That is the last thing that we are talking about. Easy. Sasa kuleta maneno. Accounting rate of return is the last point. Is our last point. Accounting rate of return is our last point. Are we done? 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 I want us to call this class off now.